Investing is a careful journey towards financial goals requiring thoughtful steps. Selecting the right investments and allocating funds involves a lot of planning and calculations in paper. While planning is straightforward, executing investments can be challenging. This is similar to drafting a plan to build a house in a paper, but actual construction requires a lot of efforts. This video aims to simplify investment choices to help you identify the best one for your goals. Welcome to holisticinvestment.in. How does the abundance of mutual fund options affect an investor? Assume you are at a supermarket to buy a breakfast cereal. You see different flavors and you start analyzing the taste, nutritional value, and price before picking one. Similarly, there are tons of funds available in the market. The abundance of mutual fund options can overwhelm investors. But selecting the right mutual fund involves considering factors such as risk tolerance, investment goals, fees, and past performance. With countless mutual funds available, investors may struggle with the decision paralysis and confusion, making it challenging to navigate and select suitable funds. Managing money involves choosing between various investments like stocks, bonds, real estate, and gold, each with subgroups like fixed deposit, PPF, and bond funds. Even within mutual funds, there are numerous options across different categories, totaling over 1,200 schemes in the market. To tackle this complexity, establishing filters and making essential decisions early on is crucial for effective investment decision making. Understanding financial concepts is also vital in this process. Why is it important to be aware of all mutual fund options? Understanding all the available mutual fund options is important for several reasons. First, you can't invest all your savings in one fund and achieve all your goals. In reality, you need to diversify your mutual fund portfolio based on your goals. Second, there is no universal perfect scheme without risk. Third, there is no one size fit for all. Finally, being aware of various options helps you identify where not to invest your money. If investing is straightforward and risk-free, everyone would succeed effortlessly. However, it is essential to educate yourself about different schemes to make informed decisions. Consulting a knowledgeable financial advisor can also simplify the process and enhance your investment journey through a holistic approach. Next, how to eliminate the mutual fund scheme that you don't require. Imagine a scenario. You are decluttering your wardrobe. Basically, you remove clothes from your closet that no longer fit or suit your style. Similarly, in mutual fund investment, you have to find out the scheme that no longer suits your requirement. Filter out funds that do not meet these criteria, such as those with high fees, poor performance history, or strategies that don't match your objectives. By doing so, you can focus on a more manageable selection of funds that better suits your needs. And then assessing your investment goals, risk tolerance, and time horizon will help you streamline your options. We will further categorize schemes based on timeline of goals to help you eliminate options that do not align with your requirements. Keep listening to understand how each scheme fits into these timelines to help you achieve your financial goals effectively. Understanding the three timelines of investment goals is crucial for effective financial planning. These timelines are categorized based on when you need the money. First, short-term goals. These are for financial needs within 3 years, including immediate to 3-year requirements. Example, taking a vacation or purchasing a vehicle. Next, midterm goals, covering needs between 3 to 7 years away. Example, saving for a down payment on a house or starting a business. Next, long-term goals. These goals require funding after 7+ years, such as retirement planning or funding your child's education. When selecting products, prioritize the time frame rather than just the potential returns. Let us know about these timelines linked target in detail to make your investment journey easy and effective. First, short-term goals. Goals that are due immediately. Key aspects of short-term investments. Accessibility. The money should be available when needed without the risk of losing its value. Next, liquidity. There shouldn't be any delay in liquidating the investment. Next, safe investments. The capital protection should be prioritized than returns. Key recommendation for short-term investments are consider options like savings deposit, fixed deposit, liquid mutual funds for increased liquidity and potential returns. Utilize liquid funds for very short-term needs. Choose money market funds for needs within 2 years and consider banking and PSU bond funds for needs beyond 2 years. Target maturity funds can be an alternate option for specific goals, but stay updated on their performance and features. Next, midterm goals. Midterm goals are due after 3 years. Aim to generate returns within 3 to 7 years, typically for larger financial objectives. Key aspects of midterm investments include higher potential returns. Compared to short-term investments, midterm investments offer higher growth potential over time. Diversification. A diversified portfolio reduces risk by spreading investment across different assets. Flexibility. Midterm investments allow some flexibility in accessing funds if needed before the goal deadline. Recommended midterm investment options include banking and PSU fund, safer than fixed deposits. They offer better returns, especially for goals within 5 years. Next, conservative hybrid funds, balancing risk with stock and bonds, ideal for goals beyond 5 years. While other options like duration based funds and corporate bond exist, they may lack liquidity and carry risk related to interest rate change and credit downgrade. Target maturity funds are a newer option for specific goals. Consulting a financial advisor is crucial for personalized guidance, especially regarding riskier debt fund options like floating rate fund or credit risk fund as goal approach. Next, long-term goals. Goals that are due after 7 years or more, like retirement, kids' education, or kids' marriage. These goals, which are decades away, require a long-term investment strategy to build a substantial corpus. Here are the benefits of long-term investments. First, compounding returns. Investment in assets like stocks and bonds generate returns over time, leveraging the power of compounding for exponential growth. Next, higher growth potential. Historically, long-term investment like stocks have offered higher average returns, outperforming short-term or mid-term investment despite short-term volatility. Next, inflation protection. Long-term investments can outpace inflation, preserving the purchasing power of savings over time, crucial for maintaining the standard of living during retirement period. For long-term goals over 7 years away, equity mutual funds are preferable to debt funds. Among equity categories, low-cost index funds are recommended for their simplicity and performance consistency. Large-cap funds may not offer significant advantages, while multi-cap funds provide diversification across market cap sizes. However, avoid high-risk options like sectoral or thematic funds unless you have deep sectoral knowledge and high risk tolerance. ELSS funds are beneficial for tax deductions, especially for those not utilizing PF and PPF limits. Foreign funds are high risk and suitable only for experienced investors seeking diversification. Seek professional advice for a balanced, suitable long-term investment strategy aligned with your financial goals and risk tolerance. We would like to conclude that investing is a long-term endeavor that requires continuous learning about trends and different investment options. We have categorized the investments into 3 simple categories based on your needs. First, short-term needs within 3 years. Focus on accessibility, liquidity with options like savings account, fixed deposit, or liquid mutual funds. Next, medium-term goals 3 to 7 years. Emphasize approximations and diversification. Consider conservative hybrid funds, banking PSU funds for a balanced approach with moderate risk. Long-term goals 7+ years. Aim for a mix of equity and debt instrument for a bigger corpus in the future. Equity mutual funds, PPF, PF are suitable options. If you are uncertain about investments, seek professional guidance from financial advisor or distributors to align your choices with your goals and risk tolerance. Remember, simplicity and diversification are key to building a successful investment portfolio. Happy investing. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.